Hi everyone, I'm Jeevan. Today, I want to talk about something big happening in the Australian property market. Because on 12th May, federal budget announced proposed changes to negative gearing and capital gains tax. Changes that could completely reshape the way Australians invest in property. So, if you already own an investment property, you're planning to buy one, or you're a first home buyer trying to enter the market, this is definitely something you need to know. Now, before we jump into the changes, let's keep it simple. What exactly is negative gearing? Basically, negative gearing happens when the costs of owning an investment property, like loan interest, council rates, insurance, maintenance, and other expenses, are actually higher than the rental income coming in. Right now in Australia, investors can use that loss to reduce their taxable income, which may provide a tax benefit. But here's where things get interesting. In the federal budget announced, the government proposed major changes to negative gearing rules. Under the proposal, investors who purchase existing properties after the new commencement date may no longer be able to claim negative gearing benefits against their salary income. However, new builds are still expected to qualify for negative gearing benefits. According to the government, the goal is to improve housing affordability, reduce investor competition on existing homes, and encourage more housing construction across Australia. Now, this next part is very important, especially for current property owners. The proposed changes are expected to be grandfathered. And what does that mean? It means if you already own an investment property or you sign a contract before the official cutoff date, you are expected to keep the current negative gearing rules. So existing investors may not be affected under these proposed changes. Now let's talk about capital gains tax, also known as CGT. At the moment, if you hold an investment property for more than 12 months, you generally receive a 50% capital gains tax discount when you sell the property. But under the proposed reforms, the government is looking at reducing or possibly replacing that discount system for future investments. Again, the idea behind this is to reduce speculative investing and shift more focus towards long-term housing supply. Now, naturally, these changes could have a major impact on the property market. We could potentially see less demand for existing investment properties, more demand for new builds, reduced competition for first home buyers, and possibly pressure on rental supply and rental prices. We may also see investors becoming far more selective about where and what they choose to buy. So if you're thinking about buying an investment property, refinancing, or planning your next move, it's really important to understand how these proposed changes could affect your long-term strategy. Because moving forward, structuring your lending correctly may become more important than ever before. But most importantly, these are currently proposed reforms only. They are not law yet. The changes still require draft legislation, parliamentary approval, and Senate approval before anything officially takes effect. So the final version could still change significantly. If you'd like help understanding how these proposed changes may impact your borrowing power, your investment strategy, or your future property plans, feel free to reach out and have a chat. Thanks for watching.